What is up, chat? Today I'm going to be breaking down how I caught a 250 point short today on the NASDAQ, and I'll also break down how you could have caught an A+++ long today using your first minute fair value gap. So this is going to be a very informational video, and I hope that you learn something from this and enjoy. So to get into this first trade, if you watch my YouTube videos, if you follow me, if you follow the Discord, you know I love my first presented fair value gap. That is my favorite PD array of all time. My first presented fair value gap is going to be on my chart every single day. And your first presented fair value gap, in short, is just a fair value gap that prints after 9:30. So here we have our 9:30 market open. It is just your first fair value gap after 9:30. So if the 9:30 candle gives you a fair value gap, that candle does not count. But if the 9:31 candle gives you a fair value gap, that candle does count. And 9:30 doesn't count because a fair value gap is a 3 candle pattern. If you use your 9:30 candle, you have to use a pre-market candle as well. But if you use your 9:31 candle, you use your 9:30, 9:31, and 9:32 candle, which are all New York AM open candles. So here we have our first presented fair value gap. And how do you know if this is your true first presented fair value gap? It will always do something important. Here in this case, we have our first presented fair value gap. And what does it do? It sweeps out our pre-market lows. Why is this our pre-market lows and not this and not this or not these? Well, if you tab over, I always have my 15-minute chart open because it aligns with the 1-minute chart. If you look on the 15-minute chart right here, this same low that comes from right here is this same 15-minute swing low here. So this is my liquidity. Liquidity only rests behind swing lows. It also rests in inefficiencies, but liquidity rests most importantly behind swing highs and swing lows. So here is my 15-minute swing low. So my 15-minute swing low is here. At open, we chop, and we manipulate that 15-minute swing low, which is my pre-market lows, with our first presented fair value gap. Immediately after manipulating those pre-market lows, we get a closure above our first presented fair value gap. Then we also get a retest back into our first presented fair value gap. And what do we have above here? We have perfect equal highs. The NASDAQ more times than not is not going to leave perfect equal highs behind. So here we have perfect equal highs. So where can I expect the market to draw to? If I pull up my tool here, let's say I entered here at our first presented, stop loss below the swing high, targeting those perfect equal highs. That is a easy 1 to 2 trade, and you could have been done today in 4 or 5 minutes. You could have been done. So very simple, very textbook trade. In my last video, I think I covered a similar trade using the same logic. First presented fair value gap manipulates sell side liquidity, gives you a first presented fair value gap. Through that manipulation, we inverse our first presented fair value gap to go target the buy side liquidity. So very, very, very simple trade today. Second entry you could have taken off of this was here we have a CISD or an order block here. This is a change in state delivery because we're delivering high, low, lower high, lower low, etc. And here we get a market structure shift here. Market maker model, market maker buy model. Here we tapped into this order block right here. As you can see, if you extend this price over to the right, we tap this order block here to the tick. So this would have been your second entry. If you missed your first presented inversion, you also could have taken an entry off this little teeny tiny BC here as well. So there were numerous chances to catch an entry up to these perfect equal highs here. But if you missed out on that, don't worry, because there was an amazing trade that I took today that delivered for 250 points down to your London session sell side liquidity. So the most important thing is leave that first presented on the chart for the entirety of the day. Until 4 p.m. close, that first presented fair value gap is valid. So if you see some people and they have a fair value gap that's been used multiple times, more times than not, is going to be that first presented fair value gap, because this can be used all day. As you can see here, we came, bounced back into it, bounced up, bounced back into it, bounced up again before we finally got below. But the second trade I took today was a 5-second short from around this area here. I don't have my exact entry because I took it on Top Step X, but I'll show you how you could have took this trade on the 1 minute. So in my Discord, I teach a model called expansion and retracement, which is basically waiting for smart money to align with price so that way you can have an entry. And I'll draw this out down here. So an expansion and retracement, an expansion is just an aggressive move in a singular direction, and a retracement should always offer at least 50% of the move. And when you have an expansion that turns into a retracement, that retracement should only offer another expansion. So if you pull out your fib or your gone box, whichever you like to use, I use a gone box, but here you have an expansion, and we'll turn on this so you can see it. But here we have an expansion. This right here gives you a dealing range. A dealing range is just a point between a high and a low. So in between this high and this low here is your dealing range. This is what price action is going to refer to deliver in whichever direction it wants to deliver. So here we have a dealing range, which is just in between an important swing high and an important swing low. Expansion creates that dealing range. Retracement uses that dealing range to create another expansion. And as you see here, expansion, retrace below the 50%, and then you should get another expansion. And it should be like that every single time. So I'll show you how you could have taken this trade here on the 1 minute. I took it on the 5 second because I was just being a little more precise, but you could have taken this trade, same trade on the 1 minute. So the most important thing for expansion retracement is confirming your direction, confirming your drawing liquidity. What do I see here? So if I'm looking here, I see here the NASDAQ manipulated this liquidity here. And why is this liquidity? Because this is a swing high, while also creating a bearish SMT. As you can see here, this is a bearish SMT with the ES. So NASDAQ manipulated this liquidity and created a bearish SMT with the ES. So that confirms, okay, we may not want to go higher. And we were also reacting out of a 1 hour fair value gap. I don't have that 1 hour fair value gap drawn out here, but if you go to your 1 hour chart, do a little homework, you can see that we were also reacting out of a 1 hour fair value gap. So here, why do I know this is an expansion? Expansion has to have displacement. Displacement is shown in aggression. Aggression equals fair value gaps. So here we have an aggressive bearish move. What do we have? A bearish fair value gap, which is a CB, sell side imbalance, buy side inefficiency. What happens here? I'll draw out my high and the low of the range so you can see, and we'll change this to black. So we'll use that in black and that in black. So here you see I have my high and my low of my dealing range. Why is this my dealing range? Because this is where the expansion came from. And you may ask, and it's swallowed, but there's a bullish candle here. Does this candle show me that we are bullish, or is this just a candle that opened lower than it closed? This is just a candle that opened lower than it closed. This candle showed no aggression higher. It gave no push higher, and it's also below the 50% of the previous candle, showing weakness to deliver higher. As you can see here, it's below the 50% of this previous candle. So that candle here does not exclude the rest of this entire expansion, because that is not a bullish move. This is a bullish move. I'm not going to count this entire thing as an expansion because this is a bullish move. This right here is not. So here we have an expansion. Then what did I show you in the image? We should have a retracement that leads to another expansion. Price action is going to expand, retrace into a PD array in the premium if we are bearish, to expand again lower. And you see here we have an expansion, retracement, expansion again. So let's move our dealing range. And once you get an expansion through the low, so this was our previous dealing range and this was the low. Once you get an expansion through the low, now the dealing range is reset. So here the dealing range has been reset to this new swing high and this new swing low. And then what do we get here again? Here we have a dealing range, which is a swing high and a swing low. We have expansion, retracement into what? Into this order block here. We have an order block here before this expansion leg. We retraced into this order block and did what? We expanded lower down here into our first presented fair value gap. And this is why I have this drawn all day, because on the live stream, when I was calling out these trades, I said, hey, we could turn around here, first presented fair value gap. We could bounce, offer a little bit of resistance, whatever. And first presented fair value gap is just important. You need to always know where it is. So that's 2 times in a row you've seen expansion and retracement play out. Now you may come over here and look and say, okay, I reset my dealing range. We have an expansion and we have a retracement, but this is a far retracement. And this is where understanding your higher time frames matters. So if you go over here to your 15 minute, you can see in this leg, there is no retracement in this entire sell side leg. But if I go here, put that there, go to my 5 minute chart and look at what we have. we have expansion into a retracement back above that EQ here. So this is your 50%. Retracement just needs to come above the 50% and into a what? Into another expansion lower. So this is where you have to understand what every time frame is doing. You can't get too caught up on the 1 minute. You have to understand that the 1 minute is aligned with every time frame, and it is the lowest time frame that most traders trade on. But on the 5 minute, this is a 5 minute expansion and then a 5 minute retracement into another 5 minute expansion. And my third short, so my second shorts were somewhere around here, and I got trailed out. I trailed my stop losses to, I think, here, and I got trailed out here. So I got stopped in profit for that second short. And my third short was this. Using that first presented fair value gap again, this is your ICT 2022 model, but this is your market maker sell model. So here, what do we have below us? We have, I'll type it out for you, but we have low resistance liquidity. And you hear a lot of traders say LRL. Low resistance liquidity is a pattern like this. When you have failure swings back to 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 back. So here, if you look up here above, it should be easy for price to run out all this liquidity because these are all failure swings. A failure swing is when price fails to take out the previous swing. So as you see, we failed to take out the swing, failed to take out the swing, failed to take out the swing, and failed to take out the swing. So you see here that this failure swings create low resistance liquidity. Low resistance liquidity is a high probability draw on liquidity. So anytime you see low resistance, you understand you have yourself a high probability draw on liquidity. What do we have down here below us? Low resistance liquidity. As you can see, failure swing, failure swing, failure swing, failure swing, failure swing. When you see this like this, you know high probability the market is going to take that out. All you need is an entry, and it's going to take it out with speed and aggression. What do we get here once we start taking out that liquidity? Speed and aggression. What does this give us as well once we take out this liquidity? A bearish market structure shift, which is a market maker sell model. Then what do we get after the market maker sell model? The same thing over and over again. You see here, what is this? Market maker sell model, because we were trending higher. We broke structure to the downside here. Then we expanded lower. Why is this an expansion? Because we have bearish fair value gaps. And then what do? We get a retracement to do what? To allow smart money to enter shorts. So that is 1, 2, 3, 4 expansions and retracements, all in the matter of how many minutes is this? All in the matter of 45 minutes. You could have had 4 of the same exact models playing out over and over and over and over again, and not a single loss. So here we retrace back to the equilibrium here, which allows smart money to engage with price. And then what do? We get another expansion lower. And my entry was from here. I front ran this trade expecting us to close below all these failure swings, get a market structure shift, then retrace back above to somewhere in the premium and then continue lower. So I just front ran this trade expecting all this to play out. And you see here what happens at our first presented fair value gap. We bounced at the consequent encroachment. But what am I expecting? A retracement to allow us to get more strength to push through. We push through with another expansion, close below. We also continue to push lower, push lower, push lower, push lower. And let's look here. So if you look here, let's check right here real quick. So this right here is what you have to be mindful of as well. So here you have an expansion and a fake retracement. Most traders will FOMO into this, and what will happen? Say if you FOMO'd into this somewhere in here, you take a break even. You take a break even because you didn't wait on a proper retracement. So we go here, get that proper retracement. Here we came just short of an actual retracement. So even here, you can see the same concept playing out, even though this one didn't give you an entry because we never allowed ourselves to tap into the premium. But you can see the same concept. What is this? A huge expansion. Yes, you have a bearish order block here, but this is just a bearish order block. This is not a up move. This is not an expansion higher. Why? Because there are no fair value gaps in this move. This is just a slow chop higher to do what? To manipulate traders so that we can go lower. So here you have an expansion, an entire expansion lower. you get another retracement, and then what do you get after that? After that retracement, you get another expansion down to what? Down towards your London session kill zone sell side liquidity. And you see, after we took out our London session kill zone sell side liquidity, we fizzled out for the rest of the day, and nothing else really happened. But I took shorts from here, stop loss above your protected swing high here, targeting my London session kill zone, which is 2 a.m. through 5 a.m. sell side liquidity. And as you can see there, took me out almost perfectly before we fizzled out for the remainder of the day, and that's everything that we had. But this was a very, very, very clean trade. You honestly could not have had a better day than this so far this month. This is probably the best day of the month, and there's just so much to unpack. This is definitely a day that I would take to each one of your journals, each one of your notes, break down this day fully and study this day deeply in depth, because there is a lot to learn about your first presented fair value gap. As you saw, we covered in that first trade. The second trade, you saw expansion retracement over and over and over again. That model plays out every single day. I don't care what anybody says. Expansion and retracement plays out every single day. You can always find a trade using that. And then you see how you can use your session kill zone highs and lows as great targets. As you see here, that's almost a perfect target. Where I exited my trade, you can see the market died off after that. So I hope that you learned a little bit from this video, and I'm looking forward to seeing you in the next video. If you do want more content like this, comment what you want to see, what you may struggle with learning. Comment what didn't you understand, and maybe I'll break this down in a further video. You can get more resources, and make sure to take advantage of commenting. YouTube is 100% free. Comment on my videos, someone else's videos. Just comment, man. You don't know what you don't know, and if you don't ask, you'll never know. So I'll see you guys in the next video. God bless, and you guys take care.